welcome to this week's market call.
Latest news.
As always, let's begin with the latest news. On the trade war front, we have been seeing some mixed signals, as we have seen countries enter negotiations with the United States of America in order to try to reach a deal as to either reduce the current tariffs that are being set on them or ease the possibility of future tariffs being added. This is, of course, in order to try to reduce the trade surplus that they have with the US. China has not been very favorable of these negotiations, of course, as they do believe it would hurt them in the long term. Because of this, Beijing has vowed for retaliation on both countries that sign a deal or negotiate with the US and on the US as well.
Weather.
Looking at the temperature forecast, we can expect warmer than average temperatures throughout all of Europe for the next 10 days. When looking at the precipitation forecast, we do expect some rain for most of Europe, especially in the Balkan region, and some wind speeds, although quite low wind speeds for the entirety of the European continent.
Crude oil and LPG.
Looking at the crude oil price evolution, we did see a 5% increase for both WTI and Brent crude oil price last week. This is, of course, very different to what we saw in the previous month and in the previous 12 weeks. The main reason for the increase has been the rebound that we saw. Of course, the previous decreases were caused by the hefty tariff announcements. However, some of these increases are also due to the fact that a ceasefire or peace deal has not been reached between Russia and Ukraine yet, a peace deal which could see an easement of Russian oil sanctions, which would increase global oil supply and be a bearish price factor. When we look at the Energy Information Administration report, we do see quite significant changes in their forecasts, especially when looking at the demand forecast, where we see a reduction in demand, which is very strong. This is again mainly due to the tariff announcements, which have slashed economic expectations and therefore have also slashed oil demand expectations. The last assessment of the EIA does show an overall oversupply of oil, at least up until Q4 of 2026.
Natural gas.
Moving on to gas price evolution, we do see a 4% increase, or we did see a 4% increase for calendar 26 last week, and increases all across the board, especially for Q3 25 and Q4 25 products. Looking at storage inventory levels, as in the previous weeks, we do see our levels very much below where we were in 2024, although more flexibility has been added this year, where countries should be able to reach 90% by December 1st, compared to the previously agreed upon target of 90% by November 1st. We are also now seeing more injections than withdrawals, as we have exited with a winter season where gas demand is very strong. A quick note that we did see a very strong cold spell at the end of April of last year, which caused withdrawals to actually be stronger than injections. This can also be seen in the total demand chart on the right-hand side of your screens, where we see a very strong rebound at the end of April. This will be interesting to see whether we see the same effect this year, and if not, the spread between this year's gas storage levels and last year's could narrow. Looking at global LNG export destinations, as we have mentioned in the previous weeks, we did see a very sharp increase of the total share of global LNG coming into Europe throughout Q1 2025. This was, of course, mainly due to the price premium and strong demand that we saw in Europe compared to Asia. These charts also show the incredible importance of the competition between Europe and Asia for LNG supplies, which will be even more important throughout the summer as European stock levels are much lower compared to previous years. Finally, looking at TTF investment fund positions, we keep seeing net long positions decrease quite substantially.
Coal.
Moving along to the coal price evolution, when focusing on API2 for the previous week, we saw increases of nearly 3% and very lesser to a lesser extent, increases as well for API4 calendar 26 product of 0.5%. Main reason for these increases have been the reduced or the low Rhine water levels that pass throughout Europe that could cause some supply disruption for coal exports throughout the region. We have also been seeing low Russian coal production overall, mainly due to sanctions on coal, on Russian coal to be exact, and also low global prices, which do not make it attractive for Russia to increase coal production at the moment. Furthermore, potential rumors of a further stimulus package in China could potentially increase coal demand as well. On the other hand, we are seeing stock levels both in Europe, in the ARA stocks, and in China being plentiful for the current demand that we're seeing.
EU and UK emission allowances.
Moving along to the emission allowance price evolution, when focusing on the European carbon allowance price, we did see increases of 1.7% and 1.9% for the UK price allowance. The main reason, again, for the very strong bullishness that we see in the UK compared to European power price is due to the continued talks of the support of the potential of recoupling the country's emission trading system with the current European system. This has hence narrowed the spread between both indexes, and this has caused the European prices to lower with the UK prices to increase. Looking at investment fund positions, very interestingly, the European carbon allowance has now officially hit or nearly hit net neutral, and there is a very small amount of net long positions still left, whereas the UKA future investment fund positions continue showing an increased net long position.
Electricity.
Now moving along to the electricity price evolution, when focusing on Germany, which is the most liquid market, we see increases all across the board from calendar 26 to calendar 29 for the previous week, although when looking at the previous 12 weeks, we do see decreases of 12%. This is a very similar trend as for the quarter products. We also see the same thing when looking at other European countries, with the possible exception mainly for France and Spain, as France is more dependent on nuclear production and Spain is very much dependent on renewable energy generation. Looking at the European power mix, we can clearly see, looking at the green line, that wind has underperformed this year compared to previous years in terms of its importance it played on the total European power mix, with gas taking much of its role that it lost last year. When looking at nuclear generation, especially at French nuclear generation, we have been seeing levels above 2024 levels, although we have seen decreases throughout this year as expected. The Remit forecast does suggest that nuclear production or generation will continue to increase throughout this year. When focusing on solar generation at the bottom left of your screen, as you can clearly tell, we have seen solar generation being stronger than usual, stronger than previous years, and this will be very important looking ahead into the summer months as solar generation becomes more important to the European power mix. This, of course, we do expect for both wind and solar, as capacity is increased year on year, we do expect generation to also increase year on year. And finally, looking at hydro levels, we have seen a very strong position when looking at the Nordic countries, which are very hydro-intensive generation countries, and also when looking at Iberian countries in terms of hydro stock levels. Finally, guarantees of origin price evolution. We did see a bullish trend last week, although in the previous 3 months we have seen quite sideways price movements showcasing a neutral trend after the quite clear bearish trend that we saw starting in September 2024 and ending at around February 2025. Thank you very much for joining this week's call, and we wish you all a great week.